So I'm going to talk about risk management today, and I think risk management is much more important than what people usually hear at marketing meetings, which is a lot about guessing where prices are going. I'll do some of that, but I really hope to focus on risk management. Now this is where we're at, and with the cash corn price, the North Central cash corn price, again, we've been kind of trending lower ever since harvest, but that strong basis is keeping the market pretty firm, and the cash market has been where it's at for that old crop corn. This is that same stocks to use chart, again the lowest level since 1996. The old crop supply is extremely tight. Ethanol production weakened right after the drought began to become apparent. It's since come back quite strongly. The past 4 or 5 weeks, it's been real good. Stocks, the previous week, the week before this week, fell to their lowest levels since USDA started tracking ethanol stocks in 2010. So that's been, I think, a surprise for a lot of people. The feed usage obviously is lower. We're using less feed, but that's still a fairly good base of support. The exports are really where a lot of the rationing has taken place, at least on a percentage basis. Basically, we're going to be ship out the lowest amount of corn since Earl Butz was the Secretary of Agriculture. And it'll be probably 700 million bushels or less. So this is kind of the last gas for that July futures contract, which should make the basis measured against the nearby even crazier. But you can see we've been trying to rally back up towards that downtrending channel that the nearby's been in. The June 28th reports next week are big. First, we'll get an idea of how much corn is left. Everybody will disagree with USDA unless it's a bullish number. You can pretty much bet on that. How many acres got planted? Everybody will disagree with you unless it says it's 4 million acres or less. We aren't that bullish. What's the weather for pollination? Yesterday we rallied Dees corn 20 cents because the forecast looked kind of warmer and drier. And so we're just a start, and we're going to be pollinating the crop late because it was planted late. So where's Iowa at? This is every week I make a projection of the major state yields based on the crop ratings that USDA puts out. That black line is the trend or the normal yield, so you can see we're below average here in Iowa, and we're starting out worse than we were last year. The U.S., however, is a little bit lower than average, but it's basically, so far the ratings are about average. And I make 2 different estimates for the nationwide projection. Currently, the one I'm most comfortable with is about 157 bushels per acre. That's where we're starting out. As Roger said, our share of the world corn export market is going to be the lowest basically since Earl Butz. We've been trending lower for ever since 1995-96 when our high prices encouraged the South Americans to really start growing corn big time. This is no surprise. This chart, a lot of people were kind of shocked to see it, but this trend has been going on in terms of where we're losing market share, has been going on for quite some time, not only to South America, but as Roger said, to the Black Sea countries as well. And this is to show you particularly this year why we aren't exporting. That top line is the price out of the Gulf. The blue line is the corn price out of Argentina. And that line at the bottom, the black line, is the line out of the Black Sea from Ukraine. So you can see, they're something like $2.50 a bushel cheaper than we are. And so that's why people are going to find the cheapest corn, and we do have competition that we didn't have 10 or 20 years ago. The other market factor I think we have to watch, this is the Commitment to Traders report. Comes out every Friday afternoon, shows what the hedge funds are doing, what the commercial entities are doing. The red line is the futures price. The green line is what the big speculators are doing. and the price tracks the big speculators pretty closely. And they've been getting out of the corn market since the high was put in. Right now, they're a few thousand contracts long, and maybe a little longer after this week, but not much. So the good news is that if they decide to get into the market, they have plenty of buying power. And they could drive prices higher very quickly. The bad news is that a lot of these big speculators and investors have been getting out of commodities. And this is a theme that's happening around the world for every commodity. Certainly it happened in gold today. Gold broke $1,300 an ounce. But we're seeing it happen in other commodities too. Unless you have an exceptionally bullish story to tell, people aren't interested in buying it. No doubt, you probably saw the stock market was down another 350 points today or so after yesterday's Fed meeting. Federal Reserve Chairman Ben Bernanke kind of surprised people a little bit, not by saying that eventually they would start tapering off on their quantitative easing, which is where they come in and they've been buying $85 billion of debt off the market, elevates bond prices, keeps interest rates low. A lot of that money has wound up being channeled through these speculators and investors who have poured it back into stocks and commodities. So if that money starts to go out of the market too, it's another disincentive for these big players to come in and buy corn. And what this does is deflates the price potential. Instead of $8 corn, if we get a rally, it may be $6 or $7 corn if they stay out permanently. So this is something akin to an ethanol industry, but it's money. And it's been pumped into our agricultural markets, and to the extent that it leaves, it's going to have a dampening price effect. This is the chart of open interest. This is just how many contracts are open in corn. And again, we've been trending lower. Even last year during the drought, at the peak of the drought, we were lower than we were in January 2011. It's just yet another indication that there's just less enthusiasm for commodities right now. One reason, a lot of these big banks that were doing this got criticized because they were speculating on food. It's bad PR. So some of them have stopped doing it. So this is my big table of numbers. I also update this every week. I like to work based on mathematics and numbers and modeling and things like that. So I try not to get too emotionally involved, although that's difficult. So this is where I'm at for new crop, and that's my primary focus these days. For corn acres, we see corn acres down about 1.5 million from what farmers intended in March. So basically 95.7, 95.8, down, but not a complete disaster or by any means. Talking corn crop that could be 13.7, 13.8 billion bushels. So we're going to lose some acres if we have halfway decent yields, and remember my yield is only 157, many people are higher than that. We still have a big crop. Now, I'm even more bullish on demand than a lot of people are. A lot of people will believe that demand has been destroyed, that our customers aren't coming back, at least for several years. I think people want to use corn, and they will come back. Not in gangbusters fashion, but I believe demand will be better than some people think. But still, even under this scenario, we got carry out 1.6 billion bushels. That gives us potential for rallies, but my rally target now is 516 to 585. We got up to 565, 570 the other day. So we got pretty close to this. What this is telling me is that the market kind of got up there and said, well, that's enough. You can get bullish, and this is my more bullish scenario. But again, if you look at this, that takes acreage going down something like 4%. Much bigger drop than I think is probably going to be reported by USDA. Now these selling targets kind of coincide with what's been happening on the December futures chart. Right where that circle is, we got that big downtrending channel line. It's been going on since the top of the market was put in. We might be able to get up there. That's basically 580 to $6. But unless we have some really severe weather, I don't think we're going to go much higher than that. And if you notice, where has the market peaked? And it's done this 4 times now since March. Peaked right around 565, right around the revenue protection base price. And that's what's driving the markets to a large extent these days, is that base price for crop insurance. When it's too low, the market rallies. When it gives farmers plenty of incentive and just about a guaranteed profit to plant corn, they're going to plant corn. Now, another thing I like to look at is seasonal charts. This tell us what the pattern has been over time, and I break it out to a couple of different years. The red line type of year, that's the normal year. That purpley reddish line, that's where we're at now. And the green line is what happens in the year after bull markets. And you can see normally in the year after a bull market, we actually get stronger prices, which we haven't gotten this year. We followed the more normal pattern, but we usually get some type of rally during as that critical pollination window approaches, because the market gets nervous, human nature, and we could be doing that right now. But the key thing to recognize that in both these patterns, unless we have a short crop, the market goes lower into harvest. And that's, unless we have a disappointing production for a 4th year in a row, prices are going lower. Now, another thing I like to take a look at is what are the odds of a rally? And this goes back to 1974, December futures contracts, and takes a look at how many years prices rallied, how much they went up, how many years they fell, how much they fell by. And so this is current as of this week, and it does show that there's a 50-50 chance for prices to rally into mid-July. There is potential to get a rally, to get higher prices. Most years after that, again, the market's going to head lower, and you only have chances of a good rally about one out every 3 years. Okay, so I think that should be a real warning flag. Now, another thing I like to do is, and if you went to every year in January, we put on a management summit, St. Louis, and right after New Year's, so college students can come along with their parents. And I did a presentation on this, showing people how to, this is called a data table, which you can do in Microsoft Excel. Gives you a what-if analysis. The top is December corn futures prices, that top column. Bottom of the left-hand column going down, that's your yield. So this looks at average Iowa farm, who's got 85% RP, average cost of production. And this is what happens if you do nothing. This is your profit per acre. It's not terrible, but if you make no marketing decisions, even if you get good yields and prices go down, you're not going to make any money. The other scenario we looked at, because this is pretty close to where we're at in terms of our own recommendations, is to go ahead and sell 40% of your new crop. And right now our average price is $5.84. And the black numbers, it's all black. You're guaranteed a profit. And you get a little dicey if we're $5.50 and your yields go down a little bit, you don't make much money. And if you tried to do that with today's price, yeah, you might break even at that level. But under most of those scenarios, things are pretty positive. So again, I think, if you haven't done anything in terms of new crop, it is time. Because the clock is ticking, you probably have a month. And prices may rally, may rally sharply, but there are no guarantees they will. And when they start falling, they're going to fall real quickly, and we'll be down a 75 cents before you can blink an eye. The daily limit at the Board of Trade these days is 40 cents, and so it does not take long to break the market. The computers are trading it. They aren't trading it 24 hours a day or even 21 hours a day anymore, but it's close. So it can happen pretty much any time. So if we get a big crop, say we have that carry out, say 1.6 billion bushels or more. USDA last month forecast almost 2 billion bushels of carry out. If we get that, what that's going to do is build carry in the market. Right now, the spread between December and July 2014 is running about 25 cents. If we get a big crop, that spread's going to go to full carry. Full commercial carry is around 40 cents. You can see that in past years, when we had big carry out, it got above 45 cents. So, if you don't want to do anything, one thing you can do is just bear spread the market. Sell the Ds by the July 2014. You're not going to make a lot of money. What you'll cover is your risk that we have awful basis at harvest, and you're going to have to sell some crop with an awful basis. So that's one scenario. Now you can see what happened last year. That red line moved up, Ds inverted to the July. And that's the type of market that we've been in all year because we had near record tight corn stocks. But that may not be the case. So with new crop corn, you can use your revenue protection as a put, and anytime you get a premium to that base price or close to it, I think you sell. And then your revenue protection becomes a call option. So you paid a lot of money for that stuff, so I think you should use it as much as possible. You also have to use rallies to price the non-insured bushels at a minimum. For a lot of people, that's going to be 30% or more, because that stuff doesn't have any sort of protection on it. So that's another thing. Again, you can consider the bear spread. Now, this is one of the real keys. What happens October 31st? The harvest price for revenue protection is set, and that's it. You have no downside protection. So if you haven't sold anything, and you're going to throw that crop in the bin, as opposed to just selling it across the scales at harvest, you have unlimited risk if prices go down. And there is the potential for that scenario to develop. And it's something, again, in terms of managing the risk, you need to figure out how much of that risk you want to stomach. Time to do that is now, okay? Assuming you got your beans done. But, once you get the beans planted, you really need to figure out how much risk can my operation stand. And if you can't stand a whole lot of risk, and there's carry in the market, and the basis is weak, use a hedge to arrive contract. Most of you probably don't want to use futures. Sell the carry March, May, or July, and you make money with on-farm storage in that strategy 3 out of 4 years. You don't make money every year, but it has the greatest odds of success. And if carry is big and basis are weak, it's a real good way to at least earn a return from your bins. Another thing you can do if you like to trade on the inventory you're going to be storing, consider selling some slightly, maybe $6 July 2014 corn calls, earn 40 cents premium to help protect you if the market falls. Now, selling a covered call, you cap your upside, you incur margin calls, so there are all sorts of risks to that strategy as well. You can also do a maximum price contract as well. But again, figure out how much risk you can take. Now, turning to soybeans, soybean market, we've seen kind of gradually rising prices here, firming prices this spring. We actually got the cash price to the highest point of the year. As Roger said, the basis has been crazy. This is figured off the July. Nobody's bidding off that anymore. They're bidding off August, September, November. But it's been going up and down, up and down, up and down. And it's not a game that any sane person wants to be in. Just leave it to the grain merchandisers. So the soybean stocks, 2012, they're tight. 2013 looks like they're US. This is what the USDA is that larger line. My own prediction is next to that. It's not quite so big, but it does look like supplies are going to get bigger in the year ahead. Right now, they're very tight. We've got strong crush. These are the crush numbers that came out at the beginning of the week, and we're up 3% over last year. USDA is forecasting I think a 3.5% decline. So we got to tighten up this crush even more. The way you do that is by turning the crush margins negative. Basically, they've been terrible, and this is something that we'll have to keep up. Now, these are Chinese crush margins, and to show you, we haven't been exporting many beans to China lately. Their sales have basically stopped. They're buying from South America. And their crush margins, if they take U.S. beans, have dropped down to about as low as they've gotten the past couple years. So they can make more money on South American beans. They're going to buy South American beans unless they can't get them due to all the problems. Our soybean shipments for old crop are above year-ago levels. They're very strong. Again, we've got to keep prices high, keep the cash market hard, and we're going to have to import soybeans to stretch our supplies. So, what to watch for in soybeans in the year ahead? One reason why the stock market was down today was not only the Fed meeting, but there was a report on Chinese manufacturing, which was much weaker than expected. And it looks like Chinese GDP growth may be slowing, and it'll still be 7%, which it's going to be 3.5 times ours. But they've been growing at 10-12%. If you're a math geek like I am, and you do a correlation between Chinese GDP and how many soybeans they import, the correlation is almost a perfect correlation statistically. And so that's why when their economies grow, if it grows more slowly, they're still going to import a lot of soybeans. But the growth is not going to be quite as robust. And that could be dangerous, again, in periods if both us and South America have a big crop. Now, the trouble in South America, if you've been watching the news, they're having riots in Rio and the other big cities. Tremendous inflation, all sorts of problems. They've had trouble, like Roger said, shipping the beans out. They got trouble with the Indians wanting the land and with their environmental policies. The country is kind of almost a mess. Used to be one of the BRICS, one of the fast-growing emerging economies. All those countries are having trouble right now. Argentina, maybe even worse, the continuing strikes, political uncertainty, inflation. The world situation, stocks look like they're going to be fairly large. And that's, again, we have a decent crop. South American production is also going to be big. Now, Brazil's a mess, but this is potentially good for their farmers. This is a chart of the Brazilian real, their currency. I was down in Brazil this winter. It was trading 2 for 1. It's less than that now. And farmers there are paid in their prices set on dollars. So as their currency weakens, they get more money. The stuff they buy costs less if it's priced in their local currency. So their soybean prices, if you do that conversion, their soybean prices are still going up, and their chart looks a lot more friendly than ours does. So ironically, even though their country's a mess, they could make more money if they can ship the beans out, if they don't have strikes, if they can get financing. This is a picture of a Brazilian farmer I took at a farm show, kind of like a field day. They had 100 of these booths. They're all wired up with a salesman who had Chicago Board of Trade prices being fed in live because they buy their inputs their seed was going to be so many bags of soybeans. And those soybeans are based off the Chicago price, and that's why they can wind up getting more bang for their buck if their currency goes down. Now, the Iowa soybean, this is my projected yield for soybeans. Again, it's also below average. The first ratings were out this week, and they were pretty disappointing. The U.S. yields, however, are looking good. Probably, if you dragged out till harvest, it'd be 44.5 bushels per acre. So there's potential for a pretty decent crop, at least statistically. Now, this is that same chart of the fund activity I showed you for corn. The funds have been kind of long beans. They're about half as long as they really get when they're really long. So they have purchasing power, but they also have, if they get spooked and decide to sell, it could drive prices lower. My big table of numbers for soybeans, that's what the yield is right now, nationwide. This is with no change in acres from March intentions. I don't have a clue as to what acres are going to come out as. So I did a survey online, showed it would be sharply lower. Other people think the acres should be up 1 million or 2. We may not know till January what the real story is. But if we no change in acres and a good crop, I think carryout will still be fairly tight, about 200 million bushels, but not not really tight. That's my projected selling range, and we're in that selling range now. We get 2 million more acres and good yields. We've already hit the top of that selling range this week pretty much, and I think the high's in. This is the November chart. We got all excited. We kind of broke out of this channel we've been in since the high was set, and we moved prices over that RP base price. They've been trading there for most of June, basically after Memorial Day. Again, giving producers an incentive to plant soybeans because the market was worried about acres. Well, we've been teetering on the brink of that now, and the chart's starting to look weak. Soybeans usually have more of a correlation with what's happening in the financial markets. So today just may have been noise, and we did hold that RP base price, but we were teetering on the brink of some negative chart signals, including the 200-day moving average, which is kind of the long-term trend. This is a seasonal chart for beans. That green line is this year, and you can see we've had a nice rally. The year after the bull market is the black line, and we tend to peak out about now. Tend to get a rally after a bull market in beans, and then we head lower. And so I think, again, we've got some risk in this market, particularly if we start to break below that 1285 consistently on a closing basis. What are the odds of a rally in November beans into mid-July? Again, just like corn, they're about 50-50. So that doesn't mean there won't be a rally, but if you're holding off on selling, just recognize that it's a roll of the dice at this point. This is that same what-if analysis for soybeans for a typical Iowa grower, and this is the impact of doing nothing, not selling anything, in terms of your new crop. We get lower prices, and unless you get some real good yields, you're gonna lose 25 bucks an acre. Not a tremendous amount of money, but you're certainly not going to have a profit. The trouble is that even hedging $13 beans doesn't eliminate that risk. So we really need a much larger rally to really eliminate this. So most of you probably have a lower than average cost of production, let's hope, but you need to be running these numbers because there's some potential for red ink and beans. There's potential for a lot of profits and sharply higher prices too, for that matter. Beans, I think, are going to be extremely volatile. But again, with beans, I think you got to consider pricing those bushels that are above your guarantee for RP. As we move into events, situations where the market can drop in a hurry, put options are very expensive. But now the Board of Trade offers short-dated put options, short-dated new crop put options. They cover, for example, the September ones expire in August. might be good. As we get into late June, early July, the crop starts shaping up. Buy one of those short-dated put options. It'll get you through the August crop report, and it'll get you to basically time if we know if we're going to have a crop or not. So using some of these new tools is also something to consider. We could have pretty good basis at harvest if you're harvesting early before everybody else, because the market could be short of beans. And so one thing you may want to do is basis contract if you got good harvest, and then sell a call option against it to give you some downside protection. And again, after harvest, I think you're really going to have to watch things, because we have a big South American crop. You know, we could be talking $10 or $11 soybeans again. Not a high probability, but one thing beans, you can have very wild swings in prices. There could be, however, some late season pricing opportunities. This is the long-term forecast just put out this morning. This is July, not looking too bad, but you can see that temperature one on the left starting to get hotter. And this is the one, this is July, August, September. And so definitely they can see some heat starting to build. And this would imply that the western Corn Belt, at least, could be kind of hot in August and September. So that could create potential for some rallies. Again, I wouldn't want to bet the farm on that, however. So let's talk briefly about 2014. This is a chart that compares corn and soybean profit per acre. For 2013 and the prior year, it's based on the revenue protection price that you could have gotten in revenue protection. That's the February average futures price. And you can see that in February, the past 3 years, you've been guaranteed a profit. Corn generally has been doing better than beans. That's why I don't think corn acres are going to drop a whole lot, because just corn is profitable. 2014, though, you can see the trend is lower. 2014, based on where we're at now for new crop 2014 futures, the red December and the red December, still profitable, but not as much as we've been the past few years. This is December 2013 corn. Again, we haven't been over 580 basically all year, and we rallied up to the top of that range this year. The 200-day moving average couldn't hold it, slipped back down. So, again, this is a pricing opportunity to start getting started on next year. Particularly if you're worried about this year, well, sell a little bit of next year's crop. And if 560, 580 corn is the worst you sell, it'll probably be a good year. November soybeans, same situation. We've been trending lower on this chart. We rallied up to the chart resistance, couldn't take it out. That green line's the 200-day moving average, couldn't close above that, and down we went. So again, these rallies are not lasting a long time, and there's a lot of turbulence. The good news is that even though profits are going to be down this year, it looks like, the market tends to have an impact on the price of the cost of production. The following year tends to go down, or at least the price increases are not big. So there is potential for some perhaps control in seed prices. Rent, your landlord probably won't want to hear. Some of you are probably landlords. Nobody's going to want to hear lower rent, but I think increases are definitely debatable. And some of our inputs, fuel and fertilizer, should be cheaper than you paid this year. Crude oil, record supplies. The fracking boom is doing great things, and the law prohibits us from exporting it for the most part. Diesel stocks got very tight. Hit a 5-year low after Superstorm Sandy last fall. They've been slow to rebuild. We've had a lot of refinery problems here in the Midwest. Has kept prices relatively high, higher than they should be. The price of crude oil is higher than it should be. But there's worries that the mess in Syria may boil over, start hurting oil production, Iran, you name it. So the market has some risk built into it just based on the world situation. We broke that today sharply. Again, if speculating in gold, they probably aren't buying crude oil either. And so this over the next 30 days is a pricing window for energy, seasonally. So you need to be paying close attention on your diesel needs and your propane needs. This is the Group 3, the wholesale diesel price. This is the Magellan pipeline. Normally the lows come in during the winter. That's kind of what happened this year. We didn't break the market very much, again, because supplies were so tight. We tend to get another low sometime during the summer. The swing factor in diesel basis and diesel demand is you guys. The trucks that drive stuff around the country, railroads, they use about the same amount of fuel month in and month out. You guys use a lot of fuel to plant, you use a lot of fuel to harvest, and that's what drives the basis. So if you look at the basis chart on diesel, it's the weakest during winter and also during the summertime. And that's what we're seeing now, is the basis is actually below average. Propane stocks, we hit a record last year and could well hit a record this year as well. They're starting to rebuild after the heating season. The prices, it used to be we would, that blue line, we would make our bottom right after winter. Dealers would get rid of their inventory, and then we'd firm prices all throughout the fall into the heating season. Due to, I think, the fracking boom and also these international weak financial markets that have disrupted the petroleum market the past couple summers, that hasn't happened. So prices are falling again. This is the third straight year that that's happened. But if you see where that gold line is, that's where the market bottom made its bottom last year. So we're in that pricing window now. So you need to be watching this price, need to be watching your dealer's price. The price that you pay probably 75 to 80 cents a gallon higher than this price. This is the Conway, Kansas, kind of the real ultra wholesale benchmark. They trade swaps on this. They don't trade futures. And the swaps, these are the swaps, kind of like a futures contract. It's also pointing to lower prices in July, a couple pennies. Fertilizer prices. Now, the last piece of the puzzle, they've been pretty flat here in Iowa for ammonia, phosphate, potash. They really haven't showed very much fluctuation, even though the world market has been fluctuating a lot. And that's part of the disconnect in fertilizer prices is that the supply chain, your supplier buys it, and that's kind of the price you pay, and there's not a real constant market in that. But if you watch, and every week I do a fertilizer review where I have the major international prices on there to give you a feel for what's happening internationally, because this is an international market too. This is the Gulf of the Tampa ammonia price. Normally, the best time to buy is a month with a J, January, June, or July. So we should be coming into a pricing window. We've started to pull back prices a little bit at the wholesale level. And now the price, I saw one offer sheet out of Kansas last week. They had anhydrous for $6.80 a ton. Now they're normally about 75 bucks, the western edge like about 75 bucks a ton cheaper than we are here. But based on that, and based on some of the things that are happening with swaps, you may be, in theory, you should be looking at about 720 to 760 ammonia in Iowa. But like I say, your price has been just stubbornly strong all fall, winter, and spring. It hasn't really reacted much to what's happening elsewhere. Urea had a big spike. Everybody thought farmers around the world, because the prices were so high, corn price was high, wheat price was high, they were going to buy a lot of urea, and they didn't. And then the Chinese started exporting a lot, so the price of urea got extremely, broke, something like $120 a ton. This is out of the Black Sea. It's also lower at the Gulf where it gets imported and also produced. So the other forms of nitrogen starting to come down pretty sharply. UAN also, the same deal. Prices coming down. For UAN, maybe 320 in theory should be possible, and that's about $100 under where the market is now. With DAP or phosphates, inventories got tight, and there was an expectation that India was going to be doing a lot of buying, China was going to doing a lot of buying. They didn't. The Indian government decided to cut the subsidies it gets farmers for fertilizer, so they bought less. So there's abundant phosphate on the market right now, and the price has been dropping at the Gulf. Again, it hasn't been dropping up here in the Corn Belt, but it has on international markets. This is the Tampa price. Normally we make a bottom right about now. DAP is kind of the first to bottom, starts moving higher. So in theory, there are places on the East Coast where you can get it for $5.15. So in theory, we should be getting cheaper. We'll see if it happens. Potash has we had big supplies. The same deal. Everybody got really bullish on potash. Said they were going to build new mines, and farmers didn't buy it. So the plants in Canada cut production. The plants in the former Soviet Union cut production. Supplies have started pulling back a little bit, but the price isn't going anywhere. So potash, even though the inventory has started to fall a little bit, it's still pretty large. So some places are down around 510, 515 in the Western Corn Belt, even parts of Illinois. So in theory, maybe 500. That may be too optimistic. Lastly, let's talk about the cost of money. This ties into what the Fed did yesterday. This is the prime rate. It's still low, and it's not going to probably go anywhere until 2015. That's kind of what Bernanke seemed to indicate. But the term interest rates are going up. And what we've seen, the 10-year Treasury note, a lot of real estate mortgages are based on that. It surged higher past couple days. It's up 85 basis points in just a month. That's 85 hundredths of 1%. It's still cheap historically, but that's an indication that interest rates are starting to rise, and the market controls this rate. And as the Fed starts buying less of this debt off the market, the price is going to keep on going down, and that raises interest rates. And when the short-term rates start rising, that's when you really have to look out. But that's probably not going to happen again for a year and a half. Interest rates, everybody remembers, the 1980s. The real impact of interest rates is on the capitalized value of land. And this is the value of land based on different interest rates with a $270 cash rent. And price of land in Iowa, the average was over $8,000 an acre, which says we still have some wiggle room because that's an interest rate of about 3.5%, 4% that it could take. So land from this perspective, from the financial guy's perspective, is still cheap. But as you start going out this curve, 5%, 6%, the value of land drops. And if you drop that cash rent, the revenue that the land makes, the price of land drops. So again, this is not something that's going to happen overnight. Not like the 80s. You've probably heard this. Farmers didn't borrow money to buy that land. They're paying cash. That's kept the debt-to-asset ratio very low. This debt-to-asset ratio will go up if the price of the asset goes down. Not going to be like the 80s, however. We can still cash flow that debt pretty comfortably, and this can absorb some pain. Every week, I update all the charts you see here, all the graphs. I update all that stuff on our website with weekly reviews for the major commodities, as well as fertilizer and energy and the financial markets, which particularly the fertilizer one is extremely well read. Also, I do the morning comments online 7 o'clock every morning or so, and we videos, audio reports, all sorts of other things on the website.